G'day everyone, and welcome to the first quarterly report for 2016. And it's been quite a volatile start to the 2016 year, as I'm sure you're aware. Once again, China is in the front of investors' minds as we continue to see a transition from the manufacturing-based economy to a services-based economy, and that's the challenge for Australians, is really how we can best tap into that change now that the resources boom is essentially at an end. It's going to be very interesting also to see what the RBA does in relation to interest rates. We've seen the reduction in the resource prices and commodity prices affecting our terms of trade, and as a result of that, and also the Fed's decision to not increase rates at the same level as they previously anticipated, the Australian dollar has gone from really the 7-year lows of around 68 cents up to around 76 cents or so at the moment. That's had a short-term effect on our international exposure, and then particularly the unhedged exposure, but we don't see that as a longer-term concern, because really the RBA have clearly indicated that they're wanting to see our currency around that 70 cent mark. So it'll be interesting this next quarter to see if they do in fact cut rates as a result, to try and keep that currency under control. If they do cut rates, we're obviously going to see a pullback in the more conservative side of the portfolios and our defensive assets, and once again that'll then have investors looking for higher returns and higher income from other assets. So blue chip assets, such as blue chip shares and quality property and quality growth assets providing good income of anywhere between 5 and 12% is going to become extremely attractive despite the volatility in the capital prices. The 12-month figures haven't been great, there's no doubt about that, but what we need to remember is the particular part of the cycle, the investment cycle that we're in. So for growth assets, and depending on your risk profile, your growth exposure, you will see negative returns anywhere from 1 in every 4 years to 1 in every sort of 7 years, and that's just a normal part of the process. It is important, however, to review the portfolio on a regular basis, on a would we buy it now basis, and ensure that we have got the right assets underlying. Once again, I hope you enjoy the quarterly report, and if you have any queries, we look forward to speaking with you shortly. Cheers.